Hi, I'm Steve Bigger, Director of Equity Research for S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is telecommunications analyst Jim Mormon. Jim, welcome to the program.
Thanks for having me.
So this week's focus stock of the week is Crown Castle. Can you tell us a bit about the company and why you like it?
Yeah, absolutely. They're one of the leading tower providers in the U.S., which means they lease space on their towers to service providers within the U.S. Now, they have built-in rent escalators to the leases that they have, which generally run 5 to 10 years, which means it's a very stable business model, as they have a high predictability with their revenue streams.
So all the competition that's going on between Sprint, Verizon, AT&T, is that helping or hurting the tower companies?
Right. Near term, actually, it's helping them. I think right now they're competing in terms of network quality, particularly the rollout of LTE, and they're all bragging about who has the greatest LTE coverage. So as long as that continues, and they really want to brag about their coverage, towers are an integral part of having better coverage. The more towers you have, the more equipment you have on the towers, better for providing service, the more rent that goes to the tower providers. So right now, it's pretty much a sweet spot for the tower providers.
So it seems like there's a lot of acquisitions in this space.
Right.
How is Crown Castle doing?
Right, they're doing actually very well. They've made two big acquisitions that I think, one of the reasons why the stock has probably lagged a little bit this year, two big acquisitions that kind of weighed on their margins. However, with the tower business, they bought towers from T-Mobile USA, which had a very low tenancy per tower, around 1.6 tenants per tower, which is very low compared to the company average. And this also had margins of around 37% for EBITDA. So you've got a company average around 63%. So now as you start to add more tenants on those towers, all that goes to the bottom line. So that'll take margins up pretty fast. So you've got a lot of increased revenue growth when you start putting more tenants on the tower. Margins start to expand, and that's one of the reasons why I'm so bullish on the stock right now.
So they've recently filed to become a real estate investment trust, right? What's the story there?
Yeah, so that was expected more in 2015, 2016. I think they wanted to get it out of the way just because there's been some concern about who can get REIT status. They believe they're definitely integral in the real estate business, and that's why they should have the status. I think it'll benefit shareholders. It'll allow them to minimize taxes as well as return cash to shareholders. However, the dividend may be a little bit on the low side in the near term because they still have a lot of net operating losses. They originally wanted to wait and exhaust their net operating losses, so that will offset some of the money that they have to distribute, but I think over time it's a good thing for investors.
Now, all of the LTE switch and data usage, which is exploding, so how's that impacting them?
Yeah, that's one of the big things for them right now is LTE, because people are starting to use so much data, and eventually they'll start using mobile video, and that's when data consumption really starts to skyrocket. Because of this, they need more space, they need more capacity, so they need to rent more equipment space on towers, and they need additional towers to add capacity. This and the move to what's called voice over LTE or VoLTE, this requires to put the cell sites closer together. So again, it's more leasing revenue for the tower. So right now, it's a win-win for them going forward.
Great. Thanks, Jim.
Thank you.
And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.